But I think broadly, you're going to see a bigger credit market start to emerge in crypto. Historically, when markets go down, people would just be you're in Bitcoin, you're in ETH, and you're in all these altcoins, and everything's just a derivative of the beta of the overall market. But you can use different parts of the investment universe to get different types of uncorrelated and diversified returns. You can get credit like downside, but crypto like upside. The biggest theme for this year and potentially the next year or so is...
This episode is brought to you by VanEck Semiconductor ETFs. You'll hear more about the VanEck Semiconductor ETF, ticker SMH, the largest semiconductor ETF, and its newer VanEck Fabless Semiconductor ETF, ticker SMHX, later in the show. The Blockworks Digital Asset Summit, crypto's premier institutional event, is back in London this October 13th to 15th. You've got top speakers from BlackRock, Circle, Coinbase, the UK Parliament, and Athena, all under one roof. I'll be there as well, hosting a live forward guidance episode with Quinn and a few others. So if you want to see us record in the flesh or meet some of the other legends on the forward guidance community, this is your shot. Notable macro names like Michael Howell of Cross Border Capital and Jeff Park are already confirmed, with more coming. There's also a VIP dinner on the 13th that will sell out fast. That's for speakers and VIP ticket holders only. It's at Old Billingsgate in London. Use code FORWARD100 for £100 off. See you there. Nothing said on forward guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, everybody, welcome back to another episode of Forward Guidance. And joining me today is David Grider, partner at Finality Capital Partners. David, you're actually on a panel with me at Permissionless a couple months ago. We talked about digital asset treasury companies. We were joined by a whole host of others. And I was just reflecting, and I really enjoyed our conversation. And also, before the panel, we had a really great macro chat and learned a bit more about your process and your background. And I was just like, oh, man, I got to get this guy on the show again. Just like, sit down and properly chat. So David, really great to have you on the show.
Well, thanks, Felix. It's an honor to be here.
So I would just love to hear a bit about your background and how you ended up where you're at now. You're running a crypto liquid fund. I know you also have some venture in there as well, but yeah, you are a institutional allocator in the crypto space. How did you get there? And what's been your journey?
Yeah, I think like many folks, I started in traditional finance, a small investment bank out of school, did some equity research, equity capital markets. And then I went to PwC, did some consulting evaluations for, a bunch of weird, esoteric, different securities like debt equity across the cap stack, CLOs, CDOs. And that's when I got into Bitcoin, was like around 2015. And this is like $600, $600 for Bitcoin. And I was like, I could figure out how to value Bitcoin. I can invest in it. Back in that time, started investing in ETH after the DAO hack, invested with some friends during the ICO wave. And we started a small fund in the 2017-18 cycle. It was just like $5 million, mostly our money. And, we did pretty good. The fund did well. The problem was we weren't big enough to cover all the outside costs. It's very expensive to run a fund. So I went to Fundstrat, and I think everybody knows Tom Lee these days. He's really all over the place and driving a lot of price action, particularly in ETH. And, I ran Tom's crypto research business. I was head of digital asset strategy for a couple of years. And that was great because, I got to go on Wall Street and be one of the voices that was like actually writing about tokens during the 2020, 2021 market cycle. And there really wasn't people covering tokens on Wall Street. You're starting to get that now with the coverage of the treasury companies. But, a lot of big institutions were reading the research. And then I went to Grayscale, was head of research at Grayscale, launched some of the exciting trusts, Solana, DeFi fund, the equity stuff. Got back to investing in another digital asset fund, and then launched Finality Liquid Opportunities Fund. We call it Flow, about 14 months ago. So actually in the second half of last year, and it's been a great ride ever since.
Amazing. So yeah, a lot of cross currents there between the TradFi world and the crypto world, which I think is a really nice jumping off point for understanding. Obviously, our audience here is a lot of macro first people, TradFi people that are starting to become more and more interested in crypto as it just integrates itself into the TradFi world. Obviously, we have stable coins, we have Bitcoin as its own entity, we have these digital asset treasury companies now, which are becoming a huge thing, which we obviously talked about in that panel. Before we get into the thick of it, I would love to just hear, keep trying to, find people that are really in the weeds running a crypto liquid fund, and some of the more complex dynamics associated with that, because it's a very high volatility market. Yeah, we'd just love to hear, like, what does it look like to be, running a liquid fund, and how does that compare to something on the TradFi world as opposed to that?
Yeah, I actually don't think of us as a crypto fund. I think of us as a hedge fund that invests across the digital asset industry. The way we focus the strategy, I think it's interesting. You could look at, like a sector specific fund. There's biotech, but maybe energy is the best analogy in the traditional world. You got an energy focused fund. They invest in the spot commodity. That could be Bitcoin, ETH, etc. They can invest in derivatives around it, futures, options, but they can also invest in the companies. It could be a small cap E&P, it could be a large cap major, one of the Exxons, and it could be across the cap stack in debt and equity. And, the way we try to approach it with our fund is maybe a little different than most other what you'd call crypto funds. We try to approach it from that perspective of, there's this new industry, there's a lot of interesting opportunities both across the traditional world and then the digital asset native world. And we can invest in these different securities or, non-security commodities that we can take advantage of the market environments. And that's kind of the way we kind of look at the universe. And then how you approach that strategy and the framing obviously has a lot of macro and fundamental, underlying, things you have to do to approach that and hopefully, get good returns for your investors. But that's generally the overview for our thesis.
How do you manage the risk of it, and how do you measure success? Because this is something I've been thinking a lot about, which is, just trying to understand risk adjusted return within the realm of something with such high volatility. Like, does it make sense to benchmark yourself against, I don't know, like the S&P or something like that, or like a 60-40 portfolio? Like, yeah, how do you think about this notion of risk adjusted return in the digital asset space, and how are you benchmarking that success?
You might have asked one of the hardest questions for any digital asset fund. What do you benchmark yourself against? It seems like it could be simple, right? I don't think anyone really knows the right answer. I think for the simplest one is like Bitcoin. People will say Bitcoin. But there's also a lot of recency bias. So if it was 21, people might want you to benchmark versus ETH. They might want you to start benchmarking versus ETH. And, 3 months from now, they say, I could have just bought ETH for the last 3 months, right? But, the answer for what we do, we're pretty transparent. We don't need to give, when we talk to investors, we give them almost every flavor, right? We give them what we think could be the main liquid assets. We do the indexes of the multi-asset indexes for crypto, the market cap weighted ones. And then we also look at TradFi and some of the fund indices and say, pick your flavor. You can compare us to this. But I think most funds I talk to, most funds try to benchmark themselves versus like the Bloomberg Galaxy or some crypto 30 index. It's actually a funny thing though. I think right now, instead of Bitcoin versus Bitcoin, because they say, oh, we own tokens, it's more like equity investing. But I think, right now, maybe that's not the best place to be as a token manager. And we haven't been playing there a lot. But, I think a lot of folks fall into that bucket, but it's kind of like and they can outperform that bucket if you're like on one of these indexes, but maybe they're like being the Russell 2000 manager. Maybe I told someone today, it's like, liquid and being a liquid token fund and investing against the token indices and being those like outperforming the Russell. Maybe you did great for that, but maybe you should have just been in the NASDAQ, right? And so I think that there's some other, areas of the market where you can play, whether that's cross equities, the other areas, et cetera, that are interesting, that are more like the NASDAQ. And we just want to be nimble and go across them.
It's an interesting one because it's always this difficult challenge, right, of outperforming your benchmark. And let's just use for like this way we've just said super simple terms. Okay, Bitcoin is our benchmark. So, okay, you have the situation where it just feels like the beta is the thing that has just been so durably strong, which has made it very difficult for funds of any means that are trying to seek out this alpha to outperform that. What do you view as like the main sources of alpha for the crypto world as like an institutional trader, and especially for those that are listening that are maybe like a portfolio manager in the TradFi world, seeing a lot of these things happening, these digital asset treasury companies, stablecoins, yada yada yada. Yeah, what are the main sources of alpha that you see in the crypto world? Breakthroughs begin with semiconductors. With over $23 billion in assets under management, the VanEck Semiconductor ETF, ticker SMH, is not only the largest semiconductor ETF, but it has also outperformed the next largest semiconductor ETF. It is built on an intelligently designed and constrained index that includes the whole sector stack, from design to manufacturing. Historically, this unique construction and methodology have helped SMH outperform its closest ETF competitor, check out the table below. Go to vaneck.com/SMHFelix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
Well, I think the main source of alpha is just being able to manage risk. I think a lot of folks really got hurt in obviously January and February. Our strategy, we have, my partner Kamal is like a quant genius. We have a macro signal. We took a lot of risk off based on that. It's a discretionary signal, but we went to, 50, 70% cash the end of last year, beginning of this year. That helped. And I think, one, being able to compound and manage risk, both with managing your gross exposures when everyone's bullish maybe and trimming there. But also, I think in the strategy mix is also an important thing. So, you can have a strategy mix that can be diverse, can give you diversified returns. So historically, when markets go down, people would just be you're in Bitcoin, you're in ETH, and you're in all these altcoins, and everything's just a derivative of the beta of the overall market, right? And to some degree, that's a derivative of the beta of high yield and of equities, right? Because the macro cycles, crypto certainly moves together with those on the risk curve. But now, with the way that the market is maturing, things that we're looking at with our strategy and we've done is, like I said, we didn't want to be in cash in the beginning of the year. So in February, we went and bought the MicroStrategy preferreds. And, you can use different parts of the investment universe to get different types of uncorrelated and diversified returns. So we got paid 9% effective to own those. We then they traded up on us some because rates were, people were pricing in a bunch of Fed cuts, right? Because the world was falling apart, at that beginning part of the year. And then we said, okay, like we're close to the bottom, right? Maybe we don't know. Bitcoin could fall out, go to 60K from here. It's like 80. How do we want to get exposure? Well, we can use other instruments like MicroStrategy senior notes, right? And we could get crypto upside, credit downside. And then go, as the market came out in April, May, you can go back into directional or long, just digital asset exposure. But I just think the two components I'd say are, one, obviously, again, managing your gross overall risk, and then two, managing your risk within your portfolio and across your strategy. And that's how we approach it, but there's obviously a lot of ways to do it.
I'm curious if you've noticed, it seems like something I've noticed over the last couple of years, which is, okay, the super simple way to describe this is either we have an alt season or we don't have an alt season. And what I've noticed over the past couple of years, and I'm curious if you've seen this in like where the quantitative correlations in crypto assets, is it feels like we've seen this maturation of the asset class, or, we have some things that are doing well, some also are not doing so well. Have you noticed that and just like correlations as you manage them through it?
What's the saying? History doesn't repeat, but it rhymes. I think we've actually had a great alt season. I think the alt season has just been in equities, crypto related equities. I mean, if you look at what's happened in, you could say the DATs, but even Circle, Coinbase, Galaxy, a lot of the miners, right? You've had an alt season in the TradFi crypto related universe. And, I think because it doesn't show up in your DOM chart, right? Your CoinMarketCap DOM chart of tokens, maybe it's not as readily apparent to everyone, but I think being able to realize like where the flows are coming from and then where the like fundamental dynamics are at play. So like why do I think we haven't had as much of an alt season in tokens? Well, I think you have seen unique tokens have great outperformance on their own, but it's just very select handful. And it's usually the ones that have better fundamentals, I think, is what we've seen. Lately, it's been, ones that are behind this ETH narrative and trend. But a big part of the problem is things just get so sold from the venture universe and the capital allocation there, right? You got 80 billion of venture. Maybe there's, 20 billion of fundamental hedge fund money trying to buy that, and the crypto's token sphere. And it's just a mismatch, right, of supply demand fundamentals. And you got to go where on TradFi, the flows are coming in and outweighing the supply of TradFi related digital asset investments. And you just got to, that will flip back, right? Like you'll want to go back to tokens at some point and be there. But you just have to kind of manage, what the current environment is over time.
Yeah, it feels like that's been one cross current. It's just capital going to the TradFi world, less so into those like all-chain alts. And at the same time, you just have that constant supply issuance from the VC side of things. I'm curious as well, like another cross current is just the derivatives evolution in the crypto world. So it felt like the last 5 years or so, it's been so predominantly like, perps market driven, perpetual futures for those that don't know what those are. And we've obviously had this institutionalization of crypto assets. We now have very liquid options on like BlackRock ETFs and that sort of thing. And then I'm curious, as a professional allocator, how have you seen that evolution in the derivatives market of the crypto world?
Well, yeah, look, I think it really started in 2017, but it's grown so fast, right? And it's matured so much more in terms of infrastructure, and then counterparty reliability. And I think the TradFi adoption of these traditional securities is really the next element of that. We've gone from people trading on BitMEX to get your Bitcoin leverage, so you can do it on IBIT, right? Through we use JP Morgan as our broker, and I think that is, as you see more assets that become adopted as both ETFs, but also the futures markets. You're seeing Coinbase futures and perps being rolled out. I think as that continues to, and I think that trend is going to happen a lot faster, right? There, obviously the regulatory environment now is such a big tailwind for that, right? It's really comes down, this next leg really comes down to this regulatory environment. And you're going to want, and I mean, with these DATs, I mean, you talk to the people who are in these markets, on the derivatives markets, they're seeing for the first time, people I talk to, big traditional funds that are investing in DATs and shorting and hedging actual perps and futures on the underlyings. For tokens, you probably wouldn't think those folks would trade. But because they think they can get some relative value or some kind of basis opportunity in DAT versus the underlying, like you're creating more liquidity and more flows in that underlying just through that. So it really is like, I think the biggest theme for this year and potentially the next year or so is just the TradFi convergence. And the things that are going to do well are the things where you get the convergence, right? It started with ETFs, Bitcoin. They became DATs like MicroStrategy and Saylor, but also with ETH, and the same thing here. And then the derivatives and the futures. I think that TradFi convergence is going to be the next thing. And then the final piece of is going to be the adoption, right? There's some projects that I've seen on the venture side that are, they should have a lot of big institutions actually building on them. And that's going to be like the final piece that actually brings both, not just the flows and the accessibility, but the fundamentals to bear for letting these become, much larger markets than they already are.
Yeah, that vignette you just had of long in the DAT and short in the perps is really interesting, comparing it to the last couple cycles. We're trying to just quantify the amount of froth in the system. Historically, it's like, okay, well, if we have 100% annualized funding rates, it's clear we're getting to that froth. But okay, you're just telling me here that the froth could actually be in different vectors, which is interesting because you're having actually more shorts on the perp side of things. That might skew it a little bit. So yeah, like how do you measure and quantify just the froth in this new era of convergence that you just described?
Well, it's a good point. Look, we in the venture fund we invested in. I should mention Finality also has a venture fund. I run the hedge fund. We have a venture fund that does pre-seed, seed, Series A. We invested in Athena early on, so we obviously that basis trade is a big flow dynamic for, suppressing to some degree because of the flows. How much basis will blow out, right? And you'll see that too with on the TradFi futures, whether it's CME, a lot of these flows, if the basis is positive, they'll short the future, go into the ETF, and that's why you can see such big ETF flows for Ethereum or others. How do you measure froth? I think funding rates and basis are certainly one of them, right? That's something I always want to watch over like a medium term cycle, right? When they hit 50 and they're blowing out to 70 like they historically have, it usually marks a local top. But you can't really, maybe you want to lighten risk there and trim, but that's certainly one component. I think another measure of froth is, when you see some of the more retail dominated names start to really have, I would say more blow off top type, medium term blow off top moments, whether it's the Ripples, the Stellars, right? The non-institutionally owned names, you can get a sense there. But I think, and people have pointed to DATs as froth in this cycle. And I think, DATs are one interesting component because, you could really just bucket those in with, like an IPO wave, right? Whether there's demand for IPOs in a hot market. And you saw that with SPACs, et cetera. But I think, to some degree there's froth in that segment, right? But that froth actually is probably healthier froth for the underlying market than any froth because, as you launch all these DATs, right, the price impact for the underlying is probably still very positive, right? Because now you have these public vehicles, even if they trade down, right, to be idealistic about whether DAT's a bad investment or good, you have to really talk in specifics, right? Is it a good investment for the person in the primary? Are you going to make money in the secondary market? Is it going to cause some underlying structural issues for flows, like, deleveraging and selling during a bear market for the underlying ecosystem? But are they also going to create good underlying metrics of adoption, right? They're going to build businesses on top of the chain. So there's a lot of different nuances to how you think about what's frothy and what's good or bad for the different parts of the market, and particularly for what investments you own.
Yeah, let's double click a little further into this DAT thing, digital asset treasury companies. So obviously we had this discussion on that panel a couple months ago. We had Tom Lee there, which was awesome. Literally the day before he launched BitMine. Very awesome. Obviously, there's been a lot of success there. So, okay, I feel like a lot of the main points have been, kind of, it's starting to be like beating a dead horse. But one of them that's sort of unique that I'm curious on your take on is, it feels to me like when you look at each of these companies in isolation as like an individual company, you're like, okay, these are not that levered, especially the ones that are just, doing the at the markets and they're not even in the debt markets yet. Like it's really not that levered compared to some things out there. But then it's like, okay, well, when you combine 200 of them, do you have to view that differently? That it's sort of like on its own, it's not that risky. But when you look at the confluence of them all together, does that in aggregate increase the potential systemic risk? And how do you measure that? So yeah, well, why don't we use that as a jumping off point? Curious on your take on all that.
Well, I think there's, probably 100 billion of assets underlying NAV behind all the Bitcoin, ETH, and Sol DATs. And most of that obviously is in Bitcoin and MicroStrategy, who is, in terms of the leverage of the entire space, maybe they have maybe they have 10% or 15%, probably less than about that 15% leverage debt to equity on it. And I don't think MicroStrategy represents a leverage risk. And I don't think really the broader universe actually has room to lever up. So I think you could actually put more leverage. I'm not saying take it to 50% or 40, but you could put another 10 billion, 20 billion of leverage on the entire DAT market cap. I don't think any of the ETH DATs actually have any leverage, any of the large ones at least. So there's actually room there for those to put on leverage. And the quality or the type of leverage is also what depends for what risk you're going to create. Obviously, there's risk to the equity holder because you now have someone senior to the capital structure. So leverage inherently does create downside risk on the cap structure. But I think most digital asset investors are probably more concerned with the leverage that equates back to the ecosystem, which is going to cause someone to default, have to sell, or liquidate their assets. I think that stage of leverage is actually not really an issue at this point. There's a lot of things where you can look at, when the term structure of the existing credit come due. A lot of it doesn't come due for many years. A lot of it's what's called covenant light, meaning they have a lot of flexibility from their debt holders as to how they can manage things like collateral coverage, like interest payments, and whether they choose whether they default or not. I think there's not really a lot of risk in the default of most of the DATs at this stage. But, I think that maybe the risk to the underlying maybe comes more from if the NAVs, you get a bear market. Look, I was head of research at Grayscale. I've lived through both the GBTC ARB trade from, nearly the beginning and through the cycle of it being, obviously, like many folks, converted to an ETF. And I think the bigger risk for the underlying is not so much a leverage liquidation. It's really at this point, right? That could change, right? People can get very aggressive at different stages of the cycle. But at this point, I think it's more just NAVs fall below. You get people that are tired of the strategy. They say, I'm just going to sell my spot. And then you have somewhat of a prisoner's dilemma where those fragmented guys start to sell. But you know what? At that stage, maybe you do have someone like a Saylor come in as a buyer of last resort if it's accretive to him to buy them up. So there's a lot of dynamics that have to come into play for thinking about this market.
Yeah, I think the emphasis on nuance there is really important. It's not just it's not as simplistic as it looks on the surface. And okay, so I want to look into specifically as we see this evolution into introducing debt markets into, say, the ETH DATs, which are all the rage right now. And to your point, there hasn't actually been any execution on that quite yet. They're all still so far just doing the at the markets, issuing equity. We have not seen convertible bonds or prefers yet, like MicroStrategy is doing. So, okay, first question on the convertible bond side of things. To my understanding, one of the big reasons why there's such low default or liquidation risk for MicroStrategy right now on their convertible bonds is because other than the initial ones that they first issued, most of these are at a 0% coupon. So there's very little interest expense. I'm curious on your take. How feasible is it for, say, these potential future ETH DATs to be able to issue converts at 0%? Is that just a unique thing for Saylor, or is that something that's achievable for them as well? And if not, where do you see those coupons and how that affects interest expense? Using a similar philosophy to SMH, the VanEck Fabless Semiconductor ETF, ticker SMHX, goes even deeper, exclusively investing in fabless semiconductor innovators designing AI infrastructure behind the scenes. We're talking high bandwidth memory, power management chips, custom accelerators, and ultra-fast interconnects, the critical components that make large AI models run faster, smarter, and more efficiently. Go to vaneck.com/SMHX Felix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
Well, the reason they could issue for zero is because people are giving them, it's embedded in the optionality that they're purchasing, right? So, because obviously a convert is a bond, and then it's an option, and that option value plus in when you issue it is really what makes up for that interest rate delta that they're not paying. So the higher the volatility of, presumably the underlying that translates to the underlying spot commodity, Bitcoin, ETH, et cetera, that translates to the stock is really what, gives them the ability to issue at better rates. Coinbase, but it's not just about the DATs, it's Coinbase too. They just priced a $2 billion convert offering. 0%, I think, was the rate. And I think it was, they did two expiries, like a 27 or 29 and a 35. And, you had, I think one had like a 35% premium and one had like a 55% premium. So that volatility is like an interesting component. I think the reason debt markets are eating this stuff up is because, from a macro perspective, I mean, we all know, like, you're not yielding a lot with debt. You're getting eroded away in monetary inflationary terms, based on the, obviously the way that the Fed, other central banks have to, increase the money supply. Well, really more the treasury side of it now in the US, but you're getting eat up in those terms and you can't get the returns, but you can get credit like downside. This is the area we're particularly interested in. You can get credit like downside, but crypto like upside. So as an example, one thing we did, there was a deal by Adam Back, who is obviously known for being an early Bitcoin founder. And, he's at, Blockstream founder as well. And he did this Bitcoin standard deal. And we participated in that, but we were interested in the senior notes, which were convertible, and then the preferreds, which were also convertible. And like, we thought those were compelling because, instead of buying the equity of one of these companies, we could get through the debt markets, you could get, we're paid 1% on the senior notes. I think it's like a 9% effective on the preferreds, right? And you can get a conversion, right? These things price at 1 NAV. Roughly, because MicroStrategy trades at a NAV to the Bitcoin. You get 1 NAV pricing and then 30% up from that on the conversion, right? And then but what do you have as the structure? You have an at the money put for 3 years, right? An at the money put, and then you have a call option 30% up, right, for 3 years, and it's like, by the way, the debt can be like 7x over collateralized. Right? So you're not going to lose money unless it goes down. So you're pretty much money good. And you can get this put and call structure in this convert, right? You can be protected as debt and you can make money two ways. It could close and Bitcoin could go up. You can make money, or it can close and the valuation could re-rate, like MicroStrategy's valuation. And Bitcoin could be flat and you make money. So there's just like if you're a credit investor, like a pure credit investor, that's compelling, right? And that was why they were able to do, all said and told, maybe $1 billion of credit on a Bitcoin DAT, right, across different instruments. And I think that that's something you're going to see a lot more of.
Yeah. Okay. So as somebody that can, basically participate in any part of the capital structure of various asset classes, I was going to ask, like, what is the incentive for you to pursue that versus opposed to, say, just structuring your own options trade on IBIT options or something like that? Like what you just described sounds quite similar to just like a call option or something like that. So is the reason that you're more interested in this because it's senior in the capital structure versus equity, or is there other reasons as well?
Well, I think the reason to do it is it's cheaper pricing than you could probably get in the crypto native markets.
Okay.
I think it's safer and I think it's cheaper, right, to get a 3-year call, 3-year put. I mean, I think it's the effective of buying the spot underlying, selling it at the money call, and then buying a 30% up call, and then using that premium of the call you sold to buy your put, right? That's how you replicate the structure. And I think it's cheaper to do it in this market, but you can also get the premium bump, right? So that's the other way, the other advantage of it on the NAV premium play. So but like doing this, the ways to structure trades like this are kind of interesting if you maybe think you're late cycle, or maybe you want to just manage risk. You don't want to take off all risk. You still want upside directional exposure, but maybe you just want on downside risk, you lose some of your call option, or maybe you just lose some of the interest rate risk because you're only getting paid 1% on that one, or maybe spreads blow out on your preferred, right? So maybe it's trading like high yield, but maybe the spread goes a little higher, right? So that's like your mark-to-market risk on those types of securities. But like it's a unique way to approach the digital asset market these days. And we think, I think there's like in the credit space of crypto, and not just because of debts, right? But I think broadly, you're going to see a bigger credit market start to emerge in crypto. And I think that there's really an opportunity for 3 types of credit strategies that can be useful. I think there's going to be performing credit that trades at much more attractive rates relative to what you would get in the broader traditional market, because this market is misunderstood and hard to underwrite. I think that there's going to be convertible upside, right, for these convert deals where you can get equity like upside or crypto like upside and credit downside. And then I think eventually later cycle, there's going to be distress. Hopefully there's not an FTX situation again, but maybe there's another Coinbase situation with some other company, right, where the bonds trade at 50 cents on the dollar. Maybe there is another FTX or a Celsius. In later cycle, you could see something like that emerge. So I think that this market is, the credit market, I think, is in crypto related credits is maybe around 30, 35 billion of total outstanding size on what I'd call 300 billion of crypto related, kind of more pure play equities market cap. And I think it's only going to get bigger.
Yeah. Have you started to game out some potential outcomes for that distressed phase? I've started to think about it myself of, okay, what happens when some of these, more long-tailed DATs start to trade at a discount to NAV? What's the calculus for thinking about where that leads? Is it a situation where, okay, they will first initially start to try to buy back their shares and sell the underlying? Do we see event-driven funds come in force and start to just, buy these up and then unwind them, capture that spread? Do we see the bigger dogs like, MicroStrategy and Tomley acquire some of these? Yeah, have you started to game that all out yet?
Well, I think what you just gamed out is probably the main pieces on the chessboard. And I think that where people will start is going to depend, what people will do, it depends where they start. If they don't have leverage, you can, without selling your underlying, you could take on leverage if you thought, okay, crypto's down 80% from here. I still have all equity. I can buy, and I'm at a discount. I can put on 10% leverage here, buy back my shares in the open market, right? Because I don't have any leverage, and I could do that without selling. I could try to get acquired by MicroStrategy at some point, because this happens in traditional markets all the time, right? Tuck-in acquisition. Company trades at a 15 PE, another one trades at a 5. It's accreted to do the roll-up because, you buy at 5, you get revalued at 15 in your book, right? And compounds your growth, right? So that grows your Bitcoin or ETH per share or whatever. And then, look, we saw that with Grayscale where, unsuccessfully, some activist investors tried to force Grayscale to do the tender offer. And I imagine that will definitely be something that happens. And you'll see that some of these companies eventually get cracked open and have to be sellers at some point of the underlying, which will, as in all markets, that will suppress the price even further. But, it's going to all depend on what the market and macro environment is. And, we'll see how that all plays out. But those are the main scenarios.
I would love for you to explain a bit more of the preferreds thing now, too, because obviously Saylor started in the converts, and now it seems like he's made a pretty strategic pivot to preferreds. I'm curious, why do you think that shift in focus? And how do you think about, I was just looking at the recent earnings presentation for MicroStrategy, and they're basically building this yield curve of various like duration based on the prefers market. And it's quite interesting, but I haven't fully landed on the right way to think about it. I'm curious if you have a framework there.
One, like you said, he's just trying to build out a risk curve, right, for Bitcoin. But two, his whole model is, look, I think that it's kind of like a bank, right? What does a bank do? A bank will take short-term deposits up and pay lower rates. Maybe I pay someone 1 or 2%, and then I buy long duration assets, right? I make a longer duration loan, which is an asset to someone else, and I collect a net interest margin. In some ways, where he's levering the capital structure, he's borrowing at lower rates in Bitcoin per diluted share terms, right? and then he's buying more Bitcoin, which is a long duration asset. So he collects a net Bitcoin per diluted share margin, right? And just like a bank, you can't be too levered. You can't have loans go bad. You can't have your collateral default on you, right? You squeeze your equity holders. It's the same, in a sense, model. So I think what he's doing right now at this stage is he's issued the equity market a lot. I think that some of the MicroStrategy shareholders are maybe not as happy with him as much as he's been selling on the ATM. But I think also the way it traded down after the announcement or last earnings call, partially the markets were a bit weak, but I think some of that was also the market maybe saying, I'm worried you're just going to lever me up and Bitcoin's going to go down, right? And you're not going to be able to tap enough to raise to grow your BTC yield. And, obviously the value of any of these DATs is really derived in their ability to, if they can successfully grow my underlying Bitcoin, ETH, et cetera, per diluted share. And the market was effectively saying, you've tapped out of your equity ability. Saylor was trying to say, no, we think it's cheap. Like a company, we're not gonna sell shares when they're cheap. We want to sell them higher, 2 to 4 range. And the market's saying, we don't believe you. We're kind of worried that you're going to just have to lever me up, and that's the only way you can get access to capital. And maybe you won't be able to lever up enough, right? You won't get enough. There won't be enough debt demand because those have been less liquid, still liquid in debt market terms, but less than the equity, less liquid options for raising capital for him. So I think that was like the dynamics at play. But from my standpoint, he's not, look, it depends. You have to always be in an evolving market environment. How much does he issue, and does he issue too much, right? Like that's the job of anyone watching the space, is to track like when the liquidation, or not the liquidation, because he's probably not going to get liquidated based on his covenants, but when what you'd consider NAV impairments are, right? How much, Bitcoin relative to how much debt he's issued. But, there's still, from this yield curve perspective, he does have everything from short duration, closer to what you'd consider, I don't want to call it a money market because the risk is much higher, but I'd call it closer to a leveraged loan structure of a leveraged loan market, because you get a floater, short duration resets, like a high yield.
That's the Strat product that they just came out with. You're talking
the most recent one. That's right.
Yeah.
I think that's closest to a leveraged loan. And you know what? But this interest rate is rich. When do you want to own something like that? Maybe you think we're running a hiking cycle, right? Now you're still going to have. So what do you get? You can reset your rate. You might have some Bitcoin spread risk if that drives crypto down, or what I would call Bitcoin risk premium, right, in the hiking cycle. But you're not going to take the duration of the longer term instruments, right? So like, his other perpetuals, those preferreds, some of these have, 8, 10, 14-year durations based on their interest rate, which means, for layman's terms, what percentage change do you get in the price of the par of the underlying, but the fair market value of it relative to percentage change in the interest rate or the discount rate applied to the security. And so those longer durations would get killed in the hiking cycle, right? So he's giving you the ability to have Bitcoin related instruments that you can go across the different regimes. So maybe you thought rates were going to fall a lot. You might want to buy the longest duration, meaning, the perpetuals, the ones that probably have the lower yield. So you'll get a higher duration on that. I know I'm kind of speaking wonkish bond terms, but for your finance listeners, they'll probably understand what we're saying here. But it gives you this optionality to play unique instruments, right, across the capital structure and stay in a crypto mandate while also getting higher returns, very collateralized relative to traditional financial credit instruments.
That is fascinating. Based on what Saylor and MicroStrategy are forging the path of where all these DApps can go. And okay, now we have these 2.0 versions that have all started to come out in the recent months. They're at the phase of the markets. They haven't gone down this path yet. What do you think is the right path for them to go based on some of the lessons that like Saylor has learned through the years? Is it worth it for them to do the converts first and then go to the preferreds market, or just skip the converts and go straight to the preferreds, or maybe something else even that Saylor isn't maybe doing?
I think it's good. It's always, what does the market bear? What is the current market environment? And then what are investors going to demand for your capital needs at any given time? Like right now, I think these guys are issuing equity because they can. It's the best and easiest place to issue. I've seen some folks start to issue converts. Look, as an investor, for me, what do I want? I prefer to have a senior note, sometimes collateralized, usually they're not, by secured collateral plus unsecured collateral, right, that can protect me. But you don't always get that, right? Most of the time they're unsecured. Senior notes is what you see most in the market. And, sometimes they're actually structuring these recently with more of an eye towards what you'd call the traditional kind of convert arb funds in the traditional market, who will get, some kind of prepaid forward or something where they can hedge out and do the traditional convert arb kind of play. For me, I prefer to own them directionally to get directional digital asset upside, right? So that's, one thing. But I think, if the market continues on a tear and there's a lot of demand for this type of capital, I think you'll see restrictions lessen. But you're obviously not at that stage for a lot of the alternative ones because, again, there is no credit on them yet, which means that it's still very hard for them to get credit. And it's going to be much more difficult for them to get credit than it is, like, I think, in crypto land, as we've seen in prior cycles. Like, we've all lived through multiple crypto cycles where BlockFi just gave credit to anyone, or Celsius, or some of the desks gave you credit, or some of the lending protocols gave you too much, right? Were reckless. I mean, in this traditional realm, for these issuances, you're going to have actual people underwrite these credits, and they're going to be much more stringent with the credit requirements. And I think so far that's why you haven't seen a lot of credit in crypto. Plus, the rating agencies haven't turned on yet, and they will. Trust me, the rating agencies are going to come. They're going to start to rate these credits. I've talked to the banks about it. They're going to start to rate them. And I think once you get that and people start to rate the credits, they start to really understand it better. I think you'll see more of a market develop, and you'll see more assets, more folks get financed in different parts of the capital structure.
I want to shift gears here a little bit, zoom out a bit, and just understand your high-level thoughts of the crypto industry. And I know that at your fund, you have this high-level macro overlay that you use to then jump as like a jumping off point in the crypto industry. So first question is, what does it look like to have like a macro overlay and then use that as like this discretionary view into crypto? Because it's something I think about a lot. I sort of feel like I operate in that way intuitively as an individual running my personal book. So would love to just hear, like, what does that look like professionally?
Well, crypto is a macro asset, of course. And I think, like a lot of listeners, they probably will understand that liquidity is a big driver. Michael Howe's obviously been the most forward with this, and is definitely like the best at liquidity data and the influence on Bitcoin and other digital assets, and risk in general, risk assets and broader financial assets in general. So we have, look, we take different macro liquidity inputs. My partner Kamal has developed a signal on that. It's a discretionary signal, and we use that to think about every month how we want to manage risk, whether we should be more risk on or risk off. And that gives us like a forward-looking view. But we have our own views as well on what we think of the macro environment that translate down into like our strategy approach, right? And how much, how we want to construct the risk that we have within the portfolio, whether we want it to be more directionally long, whether we want it to be more absolute return focused and some of the credit stuff, and then just where like the different opportunity sets lie, based on kind of what you think is going to be happening in the market. And I can say earlier in the year, and you probably know this because you read one of my notes at least from my investor letters, we were very bearish on the dollar, and that was structured with a lot of the liquidity flows and the stuff that happened with obviously the treasury QE. And we thought, that the rates picture could improve relative to what's being priced. Hasn't improved as much on the short end as you want, but we think the longer end is certainly started pricing a lot better with the recent, speculation and changes of the Fed structure. And that liquidity picture probably still has a little room to continue improving. From a macro standpoint, depends on what, as a liquid investor, it's always about time horizons, right? And positioning as well matter. And, right now, could you see a hot Fed print, inflation, and people start to price in again one of these, the Fed's going to have to be on hold more, even though the composition of the Fed's improving, right? The stagflation, everything, they price these in every 4 months or so, it seems like, and the market has to backstep eventually. But you could have some re-rating from that. But, from a macro standpoint, like broadly over the next, year end, currently, our view is still fairly positive for these kind of positive liquidity tailwind dynamics.
Yeah, we also kind of mentioned it's like I hear this language of like there's a little bit more to go. So I'm curious, like based on that framework, what's really interesting now is that based on everything we talked about these different duration exposures and views that you can take and different parts of the capital structure, you have this much more sophisticated toolbox at your disposal for somebody sophisticated like yourself. It's not just all right, 100% long Bitcoin or I'm in stable coins. You have this whole toolbox now available. And yeah, we'd love for you to just paint a picture a little bit more of like what that starts to look like. I know you've been interested in looking into say, like crypto corporate credit opportunities, stuff like that, that has a bit more of this downside protection, but still that upside exposure. Yeah, unpack and give some color around what that actually looks like.
Yeah, I think you're right with the toolbox, right? And you can use it both across, for risk management, but even across assets. Like eventually, let's say I wanted to be right now, we've caught the ETH rotation pretty well. Like a large portion of our fund is in Bitmine, BMNR, which we got into the deal of, and obviously Tom Lee is just, having worked for Tom, he's just a great operator. The execution's great. But like, I'm looking forward to the day where I could buy an ETH related credit on his capital structure. He doesn't have it yet. I don't know when he's going to, or if he's going to, but I would love to own that instead of maybe a Bitcoin credit. If I have a directionally better view on ETH relative to Bitcoin, on the underlying market, but also if I just wanted to reduce risk overall. So that's like one interesting thing. You can use the flavors to say, I have a better directional view on the underlyings, or even on the businesses, right? Some of the miners, some of the other companies that are really coming out. By the way, we're also going to be very interested in, as the universe of companies that goes public grows, I'm going to love to get a look at the Grayscale IPO. I'm going to love to see what's coming out with Kraken. These things are very much, it's not just DATs that we're interested in, right? We're interested in the real businesses that are going to come to market as well, like the Circles, like the Coinbases, like the Galaxies. We think there's a whole wave of that to happen as well. But back to the credit side, like it just gives you the tools to say, I can dial up or down my risk across the market, across different instruments or different underlying themes and flavors, and across different macro regimes as to whether I want to actually be long, duration in a rate cutting cycle, or I think I'm going to get better exposure being in crypto underlying because the rate cutting cycle is going to be good for it, right? Or just a hedge. Maybe next cycle, maybe a good hedge if the rate markets are, if we think the Fed's going to just start hiking like crazy, like 5%, maybe you should go long Circle, because Circle will benefit from a net interest margin story, right? It's going to have an improvement, and you could be long a crypto uncorrelated hedge in your portfolio, and you could be long your crypto, and you could, I don't want to call it risk parity, but in traditional finance, you can do risk parity, which is, you can have, you can be long rates or short rates. You can bet rates are going to fall, and you can be long risk, right? And those can balance each other out. And so there's much more ability to have just like interesting portfolios. I mean, another thing we've done is we've used traditional instruments to hedge, like the VIX, for example. So we bought last month. We bought calls at the end of the month on the levered VIX, and they actually the start of this month, they traded up on us quite a bit because the market started to sell off in the beginning of this month. You could argue maybe that's people trying to front run the seasonality into last month and the beginning of this month, because August is typically poor. But those actually cushioned the downside of our portfolio, because those calls we bought when crypto traded off because of it, they were up and made us money. So there's just so much of a traditional toolkit you can use across TradFi nowadays to manage risk in different ways than has ever existed in, quote unquote, what a crypto fund would do. And that's why we say we're a hedge fund, not a crypto fund.
That's so cool. I love that. It's cool to see it start to emerge. David, it's really good to get you on the show. Enjoyed that a lot. Really cool to hear how sophisticated traders like yourself are evolving as these tools come out. Where can folks go if they want to see more of your work or research?
Yeah, I mean, I think the easiest, just follow me on Twitter, at David _Gride, GRID. We have a website, finality.capital. And that's probably the main places to find me.
Awesome. All right. Well, thanks again for joining us. Really enjoyed that.
Thanks a lot.